Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Zynga. What's attractive about Zynga, why I'm not particularly compelled about it as we discuss its path for organic growth rates, and then we're going to dissect and talk about its profitability profile. Finally, we're going to bring this all together and talk about its valuation. So I'm going to just dig right in. So in the past several months, Zynga has lost about a quarter of its market cap. And back in June, I'd written that I found it difficult to be compelled towards this investment because although it has the illusion of being cheap, its organic growth isn't that strong and it's supporting a lot of its growth through inorganic acquisitions. So I was just essentially saying that cheap can always become a lot cheaper. That's not exactly a reason to be compelled towards an investment. Then, fast forward and the stock has sold off. Now, I would not have predicted that the stock would have sold off by a quarter of its market cap. But I did have enough insights not to get involved here. And that's what I was alluding to in my June article. Now, let's dig further, okay? So, if you followed Zynga for a while, you've seen that as it comes up to the latter part of 21 and really the guidance that for 2022, it's pointing towards that low double-digit revenue growth rate. So in the graph here, I put in purple 13% for 2022. That's an estimate from management. And they're alluding to that being an organic growth rate. So if you've been invested in Zynga for a while, you'll have known that since the latter parts of 2020 into 2021, the growth rates have been really, really strong. You can see here on the graph on the left. Now, if you're an investor in the stock and you've kind of been seeing these kind of high 40s growth rates, all of a sudden to be seeing it fizzling out so dramatically over the course of the year, you're kind of left, is there enough for me to be really hanging on to this investment? Okay, so let's press ahead. One of the things that I wanted to highlight is Zynga makes approximately 18% of its revenues from advertising. And if you follow this kind of mobile gaming, advertising games in general, these kind of platforms, there's a headwind. So Apple's rolling out its privacy changes. This means that you can't really track users as well. That means you haven't got a lot of information as a company to know which users are watching the adverts. That implies the value of the advert goes down. That is going to be a headwind for Zynga. Now, as I already alluded to, this is only about 20% of its business. It's not the biggest drive of the story, but it is something when a company hasn't got a lot of organic growth rate, it is something that investors should be thinking about, at least, just a question mark, that's all I want to say. Now, the average, they have this metric, is average booking per mobile daily active user. You can just think of it about ARPU or average revenue per user, something like that. And this has been trending down. Now, it has been trending down because as the users get out and about more and more, as the economy reopens, you're not able to monetize these users as successfully. So then you're left with this problem. So you've just made an acquisition last year for Peak, which is a game that cost Zynga approximately 2.1 billion. It also made an acquisition of Rolik, and so it's making these acquisitions. But once you lap that acquisition, for example, in the case of Peak, was made in July 1, 2020. As you lap that, you're kind of like, okay, what's the growth rate left on this business? So there's the question marks of the overall growth rates, and once the business acquires a large business, it has to amortize that business over time. And this leads me to the next part. So on an EBITDA profitability margin, it makes 20% EBITDA margins, okay? So far, so good, right? This seems to be a high margin business. That being said, I put here in the red arrow, nearly 40% of the EBITDA is depreciation and amortization. So again, the business, you buy up a business and then you amortize it over time because there's all less residual value to that business left. So that's added back to the EBITDA line, but it's really, you're having to spend money to buy it and then you kind of add it back. So it's like double counting. So investors, investors know this kind of stuff, and it's just something I wanted to point out there. Investors will see through this, but I just wanted to say, okay, you haven't got a lot of organic growth rate, and then there's a question mark that I would put out there about its EBITDA profitability. So with this in mind, it's kind of like, it's difficult to be particularly attracted here. Now, I make the case that investors shouldn't really be thinking about Zynga on a price to sales multiple. I believe that investors should be looking at on EBITDA profitability. Now, I'm a value investor and I look at this and it's priced at approximately, let's say, 14 times next year's EBITDA. So how did I get to this number, right? So the way I got to this number is that I've said, okay, they have taken this year's EBITDA number versus its market cap. But now let's make some assumption about how it goes into 2022. Let's say for 2022, you have less of a headwind from Apple's privacy, causing the advertising business to kind of slow down to a lesser extent, so it's a less of a headwind. And then you have some top line growth that management's pointing to approximately 12-13% top line growth, and you have some margin expansion on the EBITDA level. All blended in, you get approximately 15% year-over-year increase on the EBITDA to 660 million. With that in mind, that puts Zynga priced at approximately 12 times next year's revenues, so next year's EBITDA figures. That is not an expensive multiple. For a business that's growing at approximately 12-13% year-over-year to be paying approximately 12 times next year's EBITDA. Kind of reasonable, okay? It has approximately 1.5 billion of cash on its balance sheet, but it has approximately 1.3 billion of convertibles. So all in all, it's kind of like neutralized the cash and the convertibles, kind of a net neutral, they call it, a net neutral balance sheet. So it's not, it looks cheap to stock, but then you're really having to think, how can in 2022, how can Zynga really reignite its growth rates organically? That's really the question mark, and that's why investors are kind of like, it's not really that attractive. It's not really worth holding on to this investment. So if you want to find out what kind of stocks I'm buying, don't forget to check out my marketplace. It's called Deep Value Returns. My marketplace is aimed at people that want to improve their investment strategy. My marketplace is helping you think about investing. My marketplace has 5-star reviews. You're welcome to check them out. And you're welcome to do a totally free trial to see if it suits you. You can cancel anytime before the 14 days and you're not going to get charged anything at all. And it's really a place essentially to help you become a better investor. I give you high quality, actionable investment insights to help you compound your savings at a reasonable rate. Okay? It's a reasonable, prudent investment. Okay, so with that aside, I hope that you enjoyed this video and I hope to see you next time. Bye.